Remember, just a few weeks ago, I told you silver would bounce from exactly $74, not 72, not 71, 74. And that's exactly what happened. We saw that inverse head and shoulders pattern setting up, we watched the price action, and we waited. Silver bounced from 74 straight up to $79. Now it's sitting at 77. But here's what I need you to understand. That wasn't a buy signal. That was tape reading education. I was showing you how to read patterns, how to identify levels, and most importantly, how to wait for price action to confirm what the chart is telling you. Because without violent displacement and volume confirmation, you're not looking at a breakout. You're looking at range-bound noise. And if you don't understand the difference, you're going to get caught on the wrong side of this market. Now, if you're one of the people who's been following along, verifying the data I'm giving you, and actually learning from this process, do me a favor and drop a comment right now that says, OG John AG. I want to see who's paying attention, who's actually doing the work. And if you're not already following me on X, you need to fix that immediately. That's where I drop real-time updates, unfiltered data, and the takes you won't hear anywhere else. All the links are in the description below. Let's talk numbers. Right now, silver on the Western spot and futures markets is trading at $77. But over in Shanghai, spot silver is at $86 and futures are at $88. That's a $9 premium over the international price. Last week, that premium was $7. It's expanding. And gold, Western spot is sitting at $49.67. Now here's where things get interesting. The Shanghai Futures Exchange just suspended 2 more account groups overnight. That brings the total to 22 suspensions in 1 week. Let me be clear, that is not normal. That's intervention. The Shanghai premium has exploded to $9 over the international price, and physical demand in the East is not backing down. They're not flinching. Meanwhile, Western paper markets are consolidating, trying to hold the line through derivatives and suppression tactics. But the physical reality? It's screaming in the opposite direction. Let's look at the COMEX. Registered silver is now down to roughly 93 million ounces. They just yanked 5 million ounces on Friday the 13th. The vaults are bleeding. So the question becomes, is the COMEX fighting for solvency, or is this a managed drawdown? Either way, the situation is deteriorating. March open interest is sitting at about 60,000 contracts. That represents 295 million ounces in paper claims. But there's only 93 million ounces of registered silver to back it. The coverage ratio is worse than 3 to 1. And here's the thing, about 6,000 contracts just rolled from March to May. That's bullish positioning. That tells me desperate shorts are buying time, possibly cutting sweetheart deals behind the scenes to avoid having to deliver physical metal. Meanwhile, only about 1,500 contracts on the long side got shaken out. That's it. After all that price suppression, all that volatility, they only managed to shake out 1,500 longs. If you want to verify this yourself, go check the CME reports. The data is there. From a technical perspective, $74 held as support, just like we said it would. We bounced to 79, now we're at 77. This matches the inverse head and shoulders potential I showed you in the last video. But here's the critical part, we have not seen violent displacement yet. We need a base formation. We need volume confirmation. We need a break of resistance with conviction before the bullish thesis validates. Don't catch falling knives. Wait for the confluences to line up. We've got US CPI data dropping today, and that's going to impact silver through the dollar and Fed expectations. A hotter than expected print will pressure silver. A cooler print could fuel a rally. So we wait for the reaction. Right now, the 150 exponential moving average on the hourly chart is sitting at $81. That's resistance. As long as we're below it, silver is vulnerable to downside pressure unless we reclaim that level with conviction and volume. This is tape reading for risk management. This is how you protect yourself in a manipulated market. Now let's talk about the SLV shakeout. After all that effort, after all that price suppression, the banks only managed to extract about 2 million ounces from SLV holders. We can confirm that by looking at the share count drop. That's a pathetic result given the amount of coordination and firepower they threw at this. There was wash trading on SLV with thin net selling around 2 million shares, but holders didn't panic sell. You can verify this yourself by checking the daily SLV data. Price fell 11%, but the volume was razor thin. That's algorithmic spoofing. That's suppression without physical movement. And when liquidity is this thin, it exposes the bank's trails. These repeated everything sell-offs we keep seeing, they signal liquidity stress, margin calls, deleveraging. This isn't normal market behavior. This is crisis management. Here's the big one. The Shanghai Futures Exchange is closing from Sunday, February 15th through February 23rd. That's 8 days. And during that time, they've got 353 tons of physical silver in the vaults, which is roughly 11 million ounces, sitting against about 360 tons of open interest. That's a 1-to-1 coverage ratio. No buffer, no wiggle room, and that closure removes the arbitrage safety valve between East and West. If something breaks, the COMEX is going to break first. During this closure, expect heavy manipulation in the paper markets. Why? Because Eastern buyers will be absent. We've seen this pattern during past closures. When the East steps away, the West takes advantage and hammers the price through paper derivatives. It's predictable at this point. Now let's address the geopolitical noise. Bloomberg leaked a so-called Kremlin memo, and the mainstream narrative is trying to spin it as Russia rushing back to the US dollar under Trump. That's not what's happening. This was an internal brainstorm document about conditional cooperation post-Ukraine peace and potential sanctions relief. Russia's trade with China and India is 90 to 95% non-dollar. BRICS internal trade is 60 to 67% non-dollar. Any use of the US dollar by Russia would be narrow, temporary, and conditional. Russia has built alternatives. They learned their lesson from sanctions. The Kremlin has been clear. The US dollar is no longer the sole reserve currency, and no nation wants that burden anymore. The yuan and ruble are growing in international settlement, and this ties directly into the gold rally we're seeing. China and India have been dumping treasuries and accumulating gold. This is structural de-dollarization that started after the Russia sanctions in 2022. We haven't seen a major crisis yet, but debt stress and private equity stress are looming. The Fed's new plans are impossible to execute without money printing, which traps quantitative easing inside the US while gold becomes the global settlement asset outside of it. Let's be honest about the bearish case because ignoring it would be irresponsible. Silver is at $77, below the $81 resistance level. If we break down, we could drop to 74 or lower. The Shanghai closure creates a window for suppression through shorts, derivatives, and SLV arbitrage. The rolls we're seeing postpone delivery pressure. And let's not forget, the COMEX has contained situations like this before. JP Morgan paid a $920 million fine in 2020 and resumed manipulation like nothing happened. Capital preservation comes first. The survivors are the ones who stay positioned for the real move without getting chopped up in the noise. But here are the bullish counters you need to watch. The Shanghai premium is expanding to $9. The Shanghai Futures Exchange has 11 million ounces sitting against open interest with full allocation and no buffer. The COMEX has 93 million registered ounces against 295 million in paper claims. Despite all the suppression efforts, they only shook out 1,500 longs and 2 million ounces from SLV holders. That's nothing. 22 account suspensions at the Shanghai Exchange in 1 week, $74 support held exactly where we said it would. And the manipulation we're seeing? It shows desperation. The coordination is obvious. The volume is thin. The extraction was minimal. Here are your key levels. Silver is at 77, 81 is resistance, 74 is support. Watch what happens during the Shanghai closure. Watch for breaks of 74 or 81 with volume. March delivery runs through the 27th. The premium when Shanghai reopens on February 24th is going to tell us a lot. Look, I'm not here to predict, I'm here to observe. And what I'm observing is that the manipulation is failing to achieve its objectives. The physical market is tightening. The East isn't backing down. The West is running out of room. Invest with logic, not emotion. Stay sharp.